Welcome to our weekly investment update for Friday the 19th of June. My name is Chris Marshall. I'm Head of Investment Strategy here at Dragon Investment Managers. Now, as we look around the markets this week, we're certainly seeing an awful lot of data still coming out. We've got central bank action, we've got fiscal policy action, we've got frictions between Sino-US relationships and some very mixed messages coming out there. And also today is, of course, the end of the month for futures contracts, actually end of the quarter as well. So quad witching day as it's called. And so we could see an awful lot of volume and potential volatility come through in markets later on as the US comes online. So today's market update, I really want to touch on kind of two or three different stories. Markets are clinging to this kind of this positive trend, although there has been some increased volatility. Last week we saw the biggest down day in markets since March, and then we've seen this steady kind of tick up, but with a bit of lackluster investor attitude behind it. Although we are still seeing positive sentiment come through when we look at surveys such as bull bear market surveys. And that's continued to tick up from the very, very lows, of course, towards the end of March. So the three stories I really want to touch on are really kind of central bank action. I want to have a look at some of the data coming out from the credit rating agencies, and then also just consider the government deficits that we're seeing coming out right now. So let's start with Bank of England. Of course, yesterday we saw them come out, announce their bond buying program, and also they're keeping rates, the front end of the curve, the overnight rate at 0.1%, which is this historic low. Now, markets actually reacted negatively to this. Although it's a stimulative measure, they didn't take to a positive light on this. And this was really based on the fact that they were hoping to see the Bank of England come out and say, okay, we're going to now implement negative rates in the marketplace. That didn't happen, and so equities actually backed off slightly after the announcement was made. I think this is really a very telling point that markets are getting a little bit satiated with kind of the level of policy action coming through. It's no longer spurring on those very positive reactions in markets. And certainly when we look back to last week when Jay Powell came out and really kind of went in quite a morose statement, as Larry Summers called it. He said that there's a very long road to recovery, certainly within corporate earnings space, and the markets took a very hard stance on that and took those words to heart. So where else can we get some hard data? Because of course we know that we don't really have too much clear insight into what earnings are going to be coming out of Q2. But we can, of course, look to some of the data points coming out from credit rating agencies, defaults and things like that, which are taking a little bit of a rise at the moment. There's been a lot of central bank action again around trying to maintain liquidity in markets, and they've done a great job doing that. But of course, solvency risk is a completely other risk in the marketplace. And so when we saw the Credit Watch newsletter come out from S&P Global, it actually highlights that they've downgraded, or at least put on the downgrade watch list, nearly 2,000 issuance of bonds during the COVID-19 pandemic. To put this in perspective, during the Great Financial Crisis 2008, they only put onto this list 1,000. So this is a very significant point. Now, there have been some programs put in place by central banks that if you're within an investment grade arena, BBB arena, and you get downgraded due to COVID-19 related issues, then there is some support, but it's actually the lower rung of companies which have very poor cash flows anyway, and they're now seeing the refinancing rates absolutely skyrocket, certainly if they are downgraded to a lower rung. So for example, between a BBB and a BB rating, the refinancing rate goes up about 60%, and this is at a time when corporate earnings are under severe pressure anyway. So there is a significant risk there. It's an area that we've been looking at within Dragon for a long time, because we see this credit bubble as such as a real fragile point of the marketplace anyway, and this COVID-19 pandemic has served as a kind of a catalyst to really highlight just what might happen there. So the final story I really want to touch on then is government deficits. So this morning we saw the UK government come out announcing the highest ever government deficit, 54 billion pounds sterling for the month, and this was way above consensus estimates, which were about 47. But it also goes to show that even with the forecasts at the moment, so most westernized or developed market governments are looking at budget deficits of maybe 11 or 12%. The UK is forecast to be 11%, the US is forecast to be about 13%. They can't sustain the current payroll support and really propping up the economy as they have been. So this is going to put further pressure on governments to open up economies, to get businesses back up and running. And we're starting to see that happen, but I think these figures are certainly going to put pressure on top of that to really get things moving at a far faster pace. We also have to be well aware of the furloughed workers. So these schemes will come to an end at some point, and it's really the market trying to work out, again, how many of these people come back to full-time employment, how many only come back to part-time, and how many are actually laid off completely. So in the UK, we have just under 9 million people on the furloughed scheme, and of course we know that there's a kind of a roll down of that scheme as we get into the autumn period. So all these points are points where we could see a lot of market volatility come through, and they are points that we're watching as we construct our portfolios and how we actually enter the marketplace. So I think kind of the overall message is one where that there are some very positive and still those green shoots are coming through, but it's time to really start questioning, I think, some of the data coming through and really trying to work out, well, okay, how long will this take to recover? And this comes back into an overall theme of a very careful positioning of the portfolio. Certainly as we see this decoupling as we have over the past few weeks of share price versus corporate earnings, and also a lot of uncertainty around what those corporate earnings might look like. We continue to give performance above benchmarks, and so that gives us a little bit of room to really kind of take a stance and take a step back and really assess of where we're driving those things from that outperformance. And for us, it's really been an overweight position in some of the sectors which, of course, we would expect to perform well in a falling rate environment, and also the hopes of recovery, and this would of course include things like technology, financials, industrials and materials. So for us it's going to be very much a case of just keeping those allocations on track and making sure that we take advantage of the environment that we find ourselves in. The last thing I really want to touch on to finish with is, of course, we're going to see an awful lot of economic data being affected by what we'd call base effect. And this is really where a lot of economic data is comparing one month to the previous month or one quarter to the previous quarter. And so we saw this again this morning. We saw headlines come out saying that fastest rise in retail sales data in the UK was up 12%. But of course, this is comparing the retail sales to last month, which were minus 18%. So if actually we take out those base effects, then we see that year over year we're still down 13%. Now, the reason I highlight this is we're going to see an awful lot of this come through, from GDP data to earnings data to all the economic indicators. They're all going to be completely skewed by the base data that we see coming through. And this again is just going to really heighten volatility and almost the feelings of both euphoria or pessimism, depending on which way those data points go. So there's an awful lot to be watching for. I feel that our portfolios are still in a very good position, they're well constructed, and we're taking advantage of the sectors which are likely to keep performing well through these periods. So from myself and all my team at Dragon, that kind of wraps up this week's market update, and I look forward to speaking to you again next week. We are actually running a seminar as well on the 30th of June called Don't Fight the Fed. If you're interested in looking at what we do in a bit more detail, we can get details of that out to you if you contact us through the website. But from me and all my team at Dragon, thank you very much for listening, and we wish you a healthy and happy weekend.